All right, ladies and gentlemen, thanks for joining in. Just want to make sure you guys can hear me okay. So give me a little yes. You guys should also be able to see the screen. So we've got a little presentation slide showing up. Excellent. So the sound's okay. So we've got about half of the room full so far. We have over 200 registrants, but we've also got a limit of 100 attendees. So I think more than likely we're going to have some people logging in. So what I'll do is quickly do a quick intro. So some of you guys are, of course, familiar with myself, Cam Dadwell from thetradingframework.com. So Saul Knapp is a good friend of mine from school, but also got me into prop trading. So gave me the foot into the door to get into that world of trading. Massive trader at one point, trading the Bunds on some real big size, and also focuses a lot on trading energy spreads, which I don't really know a lot about. So I know there's a lot of you guys are interested in learning more about this, and just like I am. So listen carefully. I'm sure Saul's got some good stuff to share with us, and he's also going to show us some stuff on the platform, CQG platform that he uses. So I'm going to pass it over to Saul in about 2 minutes, and he'll get started. So maybe just give it 2 or 3 more minutes just for other people to log in. It will be fully recorded as usual, so you will get the recording. So if you do have to shoot off and you're going to miss a portion of this, you will get the recording link later today. And I'm going to pass it over to Saul in a couple of minutes. Okay, already got a question there from John. I'll let Saul do the Q&A at the end. So what I ask is basically you guys leave the questions until later, so Saul can just get through the information that he's planning to share with us. We'll leave it, until we're planning to do this presentation for about an hour. So Saul's going to talk for about an hour, share what he can, and then we'll leave about 10-15 minutes at the end for some Q&A. So please save the questions until later. Otherwise, it can just ruin the flow of things. So we'll keep that question in mind, John, and I'm sure Saul can take that later. So sound is drifting in and out for someone there. We always have some people have this issue every now and again. I usually say log out, log back in. Just make sure you haven't got something like a virus scan running in the background or a backup. That can usually cause some issues. Typically, I use this software every day with the same PC setup. So it's highly unlikely it's going to be an issue on my end here, unless everybody else all of a sudden says, yes, I've got some issues as well. But Stuart, I would just advise that you make sure you haven't got anything else running on your PC in the background. Log out, log back in, and see how it is then. Okay, so I'm going to pass it over to Saul now. So he's going to start talking in a couple of seconds. Save your questions till later, please. Okay, guys, yeah, Saul's going to take over now, so there will be some sound in a few seconds.
Good evening, ladies and gentlemen. My name's Saul, and I do a lot of work with Cam in the trading framework and Mindful Traders. We're here today to talk about some spread trading. We're going to concentrate mainly on the energy curve because it's the easiest one to actually explain about. So we start off with what are spreads? we're going to go look at what are spreads, who trades them and why we trade spreads, different types of spreads, the benefit and reduced margins from trading spreads, and the way we can offset our risk by trading spreads. So let's get started. Okay, so we're going to look at spread trading today in the energy complex. We can spread many different products. We can spread bonds. We can spread 2 years against 5 years, 5 years against 10 years. You can do index spreads, for example, the DAX versus the Euro stocks. I personally wouldn't recommend the index spreads unless you've got very deep pockets. But we'll mainly concentrate on the energy stuff today. So we'll start with the terms used in trading spreads. So when we start to trade spreads, everybody who trades outright, especially in the energy complex, we call the outright contract the flat price. So the flat price is the front month, the outright contract, and in this case at the moment is November 16 in Brent. A calendar trade or a calendar spread is established by simultaneously entering a long or a short position on the same underlying asset with different delivery months. So for example, a NOV-DEC calendar, a buy of a NOV-DEC calendar will be a buy of NOV and a sell of DEC. A DEC Jan will be a buy of DEC and a sell of Jan. So we're doing two opposing positions to try and negate our risk slightly. Can everyone hear okay? Okay, excellent. Cool. Okay. The next term we use a hell of a lot when spread trading, especially on a professional trading floor when everybody's trading similar stuff, are the legs. The legs are the components that make up the spread. So a NOV-DEC spread, you'd have a leg of November and a leg of December. So when we talk about legs, they're just the components that make up your spread. If you was trading a Bund bobble spread, for argument's sake, it will be the Bund and the bobble. Sounds simple, but people get these confused. A butterfly or a fly is a simultaneous buy and sell of two different calendars. So we'll buy a NOV-DEC and we'd sell a DEC Jan, and that will be a NOV-DEC Jan fly. This is a lower risk strategy than a calendar because you're mating two calendars of opposing positions against each other. So your outright position would look like a long one, a short two, and a long one. So you're just trying to minimize your risk and exposure to the movements of the flat price. And then when we talk about a negative spread is represented as a negative number, and the front contract will have a lower price than the next leg in the spread. So in theory, I can actually show you this. Hold on. So if you can see my screen here, this middle ladder is a NOV-16. Hold on one second, let me change this. The left-hand ladder is November Brent, and the middle ladder is December Brent. So if we took the two prices away, 45.97 minus 46.43, I'll show you the next ladder. We'll have the spread. The spread price is this ladder on the right. So the difference between the November minus the December is negative 47. And this is a typical spread in the energy complex because the forward prices are slightly higher because the cost of carry involved and more uncertainty, etc., etc. So let me just get back to the slides. So there's some of the terms we use when we're talking about spread trading. Right, in certain circumstances, spread trading offers lower margins. When you're trading for a direct market access clearer or a professional trading outfit, they correlate your risk. So, for example, an outright Brent contract or a WTI would be approximately $4,000 for you to trade. So if you want to trade more than sort of a 5 lot, you're going to need the best part of 20 grand in your account just to open that position. With a spread, the calendar spread, you tend to get a lot of correlation. Even though you're doing one November outright and one December outright, you're getting a lot of correlation on that position, and you'll tend to pay around the $600 mark for your margin. So sort of, less than a fifth of what you'd pay for an outright contract. Don't get me wrong, the outright contract is a lot more volatile and there's more opportunities, but you also carry a hell of a lot more risk. So if we look at, for argument's sake, Brent flat price, which is November at the moment, it has approximate average true range of 170 ticks. So as I said, being a volatile product, there is some great opportunities during the day, there's also some real inherent risk because oil can move $1 in a blink of an eye. But the first spread along, which will be a North Deck, only has an average true range at the moment of about 4 ticks a day. So one, you can get more size on because it moves a lot less. Two, it's a lot less margin intensive and also a lot less risky. So in the moment, in the energy curve, the front month is North 16, and you can trade right out to December 2021 utilizing spreads. There's so many combinations of spreads. I couldn't even hazard a guess at how many there actually are. You can trade so many different months, so many different spreads, so many different flies against one another. As I said, you can do flies. You can do a double fly, which is 2 sets of flies, which brings your risk in even less. It will reduce your costs margin-wise exceptionally, and there's lots of opportunities to exploit arbitrage between different products. So not only between different months in the energy curve, but you can also trade a lot of Brent stuff against NYMEX stuff, WTI or CLE, as most of you guys know it. So there's a lot of arbitrage opportunity when trading spreads as well. Right, so who trades spreads? Well, there's many market participants who trade spreads. You've got the speculative guys like myself, like Cam, funds. There's lots of people who trade spreads, market makers, etc., etc. You have producers and end users. They also trade masses of spreads. They're probably the biggest players in this arena. They want to roll their contracts into the next month, so they trade spreads. They're not always price sensitive, so they just go to market with a lot of orders. And when you can see these orders coming through in the spreads, you can get in front of them a lot of the time because they're just so much size to trade. A lot of the times, the spreads also lead the flat price. As we all know, flat price oil pretty much goes where it wants, as it's so volatile. But sometimes the spreads, when they don't want to move and they won't budge, they'll put the dampeners or the brakes on the flat price. So it's a good idea to keep your eyes on some of the spreads if you are also trading flat price oil. It's algorithmic, a lot of algorithmic and machine trading. The algos trade a lot of the spreads. There's a lot of iceberging and hidden orders in the spreads, but sometimes they can work to your advantage, especially if you know you can lay it off against another spread or another month. And there's a lot of arbitrage on algorithmic systems as well. So they're the main people who trade spreads. Right, why? As mentioned earlier, they offer a decent exposure to the underlying market, but with less risk and less margin. One big advantage for me trading spreads, I find with outrights, whether you trade S&Ps, whether you trade bonds, indexes, whatever you trade, you're pretty much either in or out. So you're either in, you're long, you're out, you're down, you're up, whatever you are, you're only in or out. There's no two ways about it. You can minimize your positions and you can add and pyramid, etc., but you're pretty much in or out with a flat price or an outright. The advantage to spreads is if you build enough spreads and you have enough different permutations of spreads on, you can trade around your position or your core position. So I try to get many different permutations of spreads on, maybe 10 different positions. You know, I might be long some, I might be short some, I might be lightening some as the market goes up, I might be buying more as it comes off because I want to lighten or extend my positions. But the beauty of spreading is you can trade around your positions, and because some of them move independently, just because flat price might be moving up, it doesn't always mean all the spreads will move up. They do tend to follow the flat price, but some spreads, there's different reasons for different maturities and different people trading different spreads. So you can take advantage of these different movements when you think something's relatively undervalued or overvalued. Another advantage with spreading is they're more mean reverting. I'm not going to put that in writing because obviously everything can blow out and everything can come to an end. But if you create the right spreads and you pick your opportunities well, they tend to be very mean reverting. And I don't just mean during the course of a day. I mean, some spreads mean revert for months and months and months, especially if you're trading the longer term spreads where the duration is longer. You've got plenty of time to trade them. If, for argument's sake, you was trading a 12-month December spread from 2017 to 2018, you've got, the best part of another 18 months to trade that spread. It's also possible to create many synthetic strategies. And Sorry, Frank, if you asked a question, there will be a recording of this interview, this webinar, yes. You can create really good synthetic strategies. As I said before, with an outright, you're pretty much just trading what's on the screen. With the energy curve, you can create lots of different synthetics. So by doing 2 separate calendars or 4 or 6 different calendars, you can create boxes, flies, arbs. You can create many different positions that aren't actually exchange listed. You're synthetically making them normally via the use of an auto spreader. And these strategies aren't so much, they're not watched so much by machines or by big players. You're almost a little bit off the radar. So it helps a lot to be making synthetic markets, because you're not actually trading an exchange listed product, and you almost create the price yourself. So my opinion, you're off the radar a lot more when you're trading synthetic stuff. You can trade synthetic stuff on one exchange, you can trade it across multiple exchanges, and that's the beauty today of some of the auto spreaders. They're all co-located at different exchanges. So types of spread in the energy complex. With your calendars, as I mentioned, that's one delivery month against another, one long against one short. Flies is one calendar versus another calendar. Arbs, there can be many different arbs. You can trade a Brent WTI arb, which is it's actually the other way around. It's quoted WTI Brent. It's listed on the ICE exchange, and it is WTI versus Brent, and it's mainly a deliverable. It's on the deliveries, so it's all about supply and demand. But it can be a very good spread. It moves independent of the 2 legs, the 2 flat price legs, which is WTI and Brent. But it can be a very good product. I find it trades very technically, and it's one of my favorite trades. A lot of the boxes, you can trade a 12-month spread on Brent, for argument's sake, December 16, December 2017, and you can trade the opposite way round on the NYMEX equivalent. So you'll be buying a Brent December 16, 17 and selling a WTI December 16, 17. These spreads are slightly more volatile than the straightforward calendar, but there is some good trades to be had in there. In the Brent complex and also the WTI complex, you can trade 1-month calendars, as I explained, would be like a December, January, or a Jan, Feb. 2-month calendars tend to be a little bit more volatile, so a Feb, April. So the further the duration between the 2 months, it tends to be the more volatile the spread will be. So then you move into the 3 months, which are all listed, exchange listed spreads. So a 3-month will be a March, June, or a June Sep, or a Sep Dec. Then your 6 months, Dec Junes, June Decs, etc., and you can go right out for a couple of years on them. And the 12-month calendars are Dec normally, which is December 16, 17, or you could do December 17, 18. And you can trade both of these, all of these on NYMEX and WTI and ICE Brent. There are countless more combinations that you can synthetically create, and it will take me forever to actually go through these. Just to slightly deviate from the energy complex, you can also trade the spreads on bonds. A lot of people trade the Eurex strip, being the 2s versus the 5s, which would be the Schatz versus the Bobble, or the 5s versus the 10s, which would be the Bobble versus the Bund. You can also trade these on the US Treasury curve, 2s versus 5s, 5s versus 10s, 10s versus 30s. Another example is the Eurex Bund versus the Life Gilt. So German 10-year bond against the UK 10-year bond. A lot of these are more interest rate plays, but you can get some good spreads on when some news has been out, which affects one more than the other. So there's some really good opportunities to be had with the spreads. There are many, many more. There's the soybean complex. We can trade the meal, the oil. You can trade the crush spread. There's cocoa, where you can trade calendar spreads, where a lot of guys do very well. There's coffee, wheat, corn. They're endless. So there is so many products you can trade against each other. We look for a lot of correlations sometimes, where we'll work out that the indexes, for argument's sake, the S&P and oil are very well correlated. So we'll try and trade the S&P against WTI, and we'll try and trade that as long as the relationship holds up. Occasionally, when the relationship breaks down, you have to know when you're wrong and maybe sit back. But there's lots and lots of different spreads you can trade, but I prefer to concentrate mainly on the energy stuff. Right, reduced margins. As I said, trading via a direct market access clearer enables you to trade calendar spreads with reduced costs and a tighter bid-ask spread. I know a lot of you guys are retail traders, and if you do trade retail, it's a lot harder to actually trade calendar spreads and flies. One, because your commissions are much higher. You tend to pay a lot more in your commission. And two, your bid-ask spreads on a lot of systems, especially CFDs and spread betting systems, the bid-ask spread is just too wide to cross. You will give away all your profit even trying to spread some of these products, unless it's something like an index spread where 6 or 7 ticks doesn't matter to you if you're running it for the long haul. But you need to trade energy spreads, you do need to ideally clear direct market access by one of the major clearers. The major clearers also offer massive margin correlation, as mentioned before. So you get a hell of a lot of correlation on your account, meaning you can trade bigger, more, and have more permutations of spreads on. Next one. Okay, so offsetting risk. Let's be honest, there's no form of trading is risk-free, and everybody knows that. Otherwise, everybody would do it. But indeed, spreads do reduce your exposure to the risk. We're still giving you a good exposure to the outright or the underlying instrument. And there is much more opportunities to make money in spreads. Maybe not as quickly and maybe not as often, but there's more permutations of trades you can do. You're not just stuck with doing one trade or a couple of techniques. You can actively trade around in your core positions all day, which one, makes it a little bit more enjoyable, and two, in the long run, it will help you out. Right. I haven't got much more to say on this today, guys, because this was just an introduction to spreads. I'm going to show you some charts just to show you what we're looking at. So on the left-hand side, we've got a Brent flat price, which is November. In the middle is December, and on the right is a spread, as we discussed before. So let's look at the charts of these. So this is November, which correlates with the ladder on the left here. And you can see an average daily range down the bottom here is about 150 ticks approximately. November should be a similar amount as well. It's 149. So this, you can see it's a tight spread. They don't move a lot from each other. And on the right-hand ladder is a NOV-DEX spread, which moves approximately, it doesn't actually move that much. Hold on one second. It's about 5 ticks a day. You may not be able to get the high or the low there, but this say between 4 and 5 ticks a day. You can see there's a lot of size on these spreads. So a lot of it is about order book queuing. But as I said before, if you was to sit in this order book and place a trade here, you can use the 2 outright legs to leg out if you really need to. If you're an outright trader anyway, that might help you. I wouldn't personally. Hold on one second, guys. Sorry about that, guys. A bit of a technical issue there. As I said before, the shorter the duration in the spread, the less volatile it tends to be. So this spread ladder on the right, as I said, is a NOV-DEX or November, December. So it's roughly a 5 tick range a day. If we go to a 3-month spread, for argument's sake, which is a December, March, this spread is slightly more volatile. So we've had approximately a 10 tick range here today. So let's just show you the chart of that. Daily chart is here, and you can see it's in quite a good downtrend. Again, we use a lot of technicals on spreads as well. We do actually have an area down here where we're interested. As I said, 10 ticks a day in that one. And then if we go to a 6-month spread, which will be, this particular one will be DEC June. So December 16, June 17. Hold on one second. bit of a problem here, guys. I have to bring it up on the chart. What's wrong with that?
Not letting you type.
No.
Oh. It might be going on a different screen. Right?
Actually, that's there. Look, 6 don't work.
Oh yeah, no, you know what it is? Yeah, it's sort of 5, 6, 7, 8, 6.
Right. Okay. We have a problem with our number 6 key on the keyboard.
Sorry guys, so we're just trying to use the number 5 and 6 on my keyboard, but it doesn't work on the normal play, so you have to use the number pad. Anyway, quick little word from me. I'm here with Saul. We're actually in this my office today, so I'm going to basically be asking Saul some questions. I think we're going to do some stuff on the fly here because I'm actually trying to understand how to trade spread myself. And Saul's been doing this a long time. That's why I think it's something that I want to learn. So what I'm going to do is probably ask some questions, which most of you guys are probably thinking about anyway. And then at the end, we take some questions from you guys as well. Yeah, so we're going to do that. But I'm just going to let Saul finish this off now, and then we'll just carry on with a bit of Q&A.
Perfect. Thanks, Cam. So the ladder on the right now, that's a June 17, Deck 17 spread. As you can see, it's had a bit of a bigger range, a 15 tick range today. Average true range down on the chart is about 13.5, 14 ticks. So the longer the duration or the maturity between the two spread months, the more volatile the spread tends to be. The last one, we'll look at a deck, so a Deck 16, a Deck 17. And that one today has had a 27 tick range. And to show you on the ladder, oh, wrong one. Give me 1 second. Yeah, there you go. So you can see there's plenty of size in these bids and offers. I mean, it doesn't look like there is, but for argument's sake, neg 442 at the minute, which is neg $4.42. It's just only recently just traded 680 lots there. So as much as it doesn't look like a lot of action goes through, we've done a total of nearly 20,000 lots in there today, and that's just in one spread. The flat price today has done 340,000 lots. So there's plenty of volume to get traded with in these markets.
Can I ask a question?
Yeah, go for it.
All right, I've got a question here, guys, because most of you guys are probably outright traders just like me. I'm not saying all of you. There might be someone here that does trade spreads. Spreads are like intraday hedges, but they're short term. Now, what I found when I got into prop trading, I can't remember how long ago, it was probably about 10 years ago. I realized that a lot of the traders were trading spreads. There was a lot of scalping. There was a lot of guys didn't have charts. I mean, I had probably some of the most fancy charts, but guys didn't have charts and they had some basic stuff on the screens. Now, spreads is something that's still pretty foreign to me. Firstly, there's not really any information out there to the retail trading world, the public retail trading world. This is why I thought it'd be good to bring Saul on, because I'm also still trying to get my head around this. So I've got a question here, firstly, because what we noticed firstly is that Saul's referring to spreads, and the actual products that we're looking at on the charts are spread charts. And also the ladders we're looking at are spread ladders. I mean, so basically I've got a question here, like the depth there, is that a combination of, so that spread is made up of, like, for example, this ladder on the right.
Yep.
What is that spread made up of? Which products?
Well, in theory, the spread will trade via the outrights if the two outright prices match. But
so which outright products is that?
This one on the right is December 16, December 2017. But if I bring up a ladder for that, there's no liquidity in Deck 17. You won't be able to physically get that trade off. QOZ6.
So is that the Brent on ice, or is that?
This is Brent on ice, but it'll be the same as WTI on NYMEX. It'll be pretty much the same. Z7.
Can you guys hear me and Saul both when we're conversing? Is that okay? Because we've got the mic pretty much between. Yeah, okay, cool. So I'm going to ask some questions, which I think some of you guys are probably thinking as well, because many of us are just used to trading like one outright product, like crude oil. That's it. We're trading crude oil December contract. We're trading, we're trading Brent on the ice December contract. We're trading Bunds. So now this is a spread. Is ultimately it's a product that is a combination of different markets. So now one of the questions I've got is, now we're looking at, for example, the depth here. The prices here is not like an outright product now, right? So we're looking at what is this, the numbers that we see here, What is that? You know,
well, it is actually an outright product. So the two legs for this spread on the right-hand side. On the left-hand ladder is deck 16. On the right-hand ladder is deck 17. Obviously, that's 13 months away, so there's not a lot of liquidity in there. So most of the prices in this deck 17 ladder, the middle ladder, will be derived from the spread ladder.
Right. Okay. And so this, like for example, the resting bids and offers, is that coming from the underlying products?
No, on some products it does, but the spread listed products on ICE and NYMEX, they're actually exchange listed. They're an outright product.
So they're actually like a different product. They're completely
just like trading the Bund or the S&P.
So it's a completely different product. Yeah. Yep. So basically, like a lot of these charts, like I know you can get these in Market Dollar. I've really struggled to set them up. Like you've got charts. This is CQG, right, guys? Now, a lot of guys, we've got the setup with mindful traders where you can clear through, prop firms, right? This is the setup we have, so we can risk provide that risk layer, the risk management layer. And also pass on the lower commissions on products that we get as well. So the thing is, a lot of retail brokers don't actually, firstly, provide platforms that can actually help let you trade spreads. It may be possible, but the reason why a lot of prop firms use like CQG or TT is firstly because they've got auto spreaders as well, but also that these products are, it's much easier to set these up. I don't know if it's even possible in some retail platforms to have these spreads laid out like this and actually trade them. So that might be a reason why prop firms do stick with CQG, Stellar, and TT X Trader. So the charts we're looking at here, in terms of like technicals, I think a lot of traders here are going to be technical guys.
Yeah.
Could you give me an example of how you would find an opportunity in finding a spread to trade? Like if there was something setting up right now, may not necessarily be now, it may have been something that was earlier on in the day or yesterday. Can you show us on the chart what?
Yeah.
Yeah.
I mean, I haven't looked today. I haven't worked, so I can't actually tell you what's happened today. But let's have a look. Let's go to this. A lot of the times we do look for standard stuff, which you guys will look for in outright trading, because as I said, these are basically outright products. But
so like if I was seeing value there, like I would see that as balance.
Yeah.
Sideways range. I would potentially say, okay, we could bottom out here, move higher. Now, could I use that as an idea?
Yeah. I mean, this chart goes back to when this spread was down, when oil was down in the mid-20s, like $27, $28 a barrel, this spread was down about neg 750. This chart might not go back this far. Let's have a look. It doesn't actually go back this far. Actually, it was the old contract. It was a previous contract. So this spread was much further down than this. But we still look back on standard levels like you would with any product, like a level here.
So I could put a composite profile on there.
Yeah, you could use a profile. I mean, we do use, this machine hasn't actually got profile enabled, unfortunately, for spreads. But we do use profile a hell of a lot on spread trading, especially on synthetic strategies. Because
so it's quite interesting to see how the stuff that I do and typically teach will apply to the spreads here.
I think it would apply quite well, especially on the exchange.
I pretty much trade like mean reversion trades.
Yeah,
I trade back to value. So if that's typically what we're seeing with the spreads, I think it's going to be I think it's a good formula there.
And you've got the fundamental reasons behind a lot of the spreads.
Yeah.
Yes, it's a cross between fundamentals and technicals. Yeah, great. I mean, a lot of the spreads, a lot of bigger guys use moving averages on some of these spreads. I mean, let's have a look at some of the moving averages.
I just wanted to get a quick show of hands, guys. Who is familiar with trading spreads and what Saul's talking about here? To like a high degree, you've been doing it, you know it, you've been trading it for a while. I'm not sure why, but Saul's focusing on what he wants to talk about today. I have no idea what you're referring to there, Marco, but maybe you could do your own webinar on that. But Saul's got his own agenda here today.
Yeah, Marco, it is. I can understand what you're saying. But if you're trading spreads intraday, I know guys who know this stuff inside out, but it doesn't really help them a lot. A lot of the stuff we trade spread wise, you're best off just trying to take advantage of arbitrage and slackness in price, and just spotting stuff that's out of line. And you can do that sometimes, looking at the curve, if it's backwardation or contango, etc., etc.
So you spoke about energy curve. Is that something we would see on the chart?
Yes, I can. This chart I should be able to show you. Hold on. Let's have a little look.
So I mean, there's not really many people, maybe just Marco there. There's not really anybody that trades spreads or has traded spreads. And this is why we're doing this. I'm learning this myself because I really, I try to understand it. I've just not been able to put my head around it. So I've always stuck to outright positions, but I think there are some benefits, as Saul said earlier. Firstly, your margins get reduced, but there's also less, you're managing your risk. And I think that's why, am I right in saying, Saul, that, prop firms, like when I went into, prop, then it was the majority of that volume was spreads, right? A lot of them were spread trades.
Yeah, there's a lot of traders. I mean, back when you were trading, it was more, the energy stuff wasn't really, when you was with us, the energy stuff
there
wasn't
was an
really
energy
online.
group. There was a few guys that were sitting there.
Yeah, there was. We had one of the biggest energy groups to start on screen. Yeah. There was energy traders, obviously, on the pits and on the floors. But when it came on screen, we was one of the first lot to actually have an energy team. Yeah. But most of the guys, when you was with us, were trading spreads on the European strip, Bunds, bobbles, your IBOR stuff, Euro dollar, TED spreads. But after the 2008, them spreads started to get very difficult, very competitive, and just downright dangerous.
But in terms of a prop firm backing traders, is it right in saying they would have a lot of traders? They would typically train up a lot of traders to trade spreads because the risk is managed a lot more.
Yeah, the risk is a lot more manageable. The margins are a lot more less. Yeah. So they can have a lot more traders trading a lot more size with a lot less money laid out. It is a lot less risky for them to have a load of spreaders rather than a load of outrights.
Yeah, I mean, for some public retail world of trading, I would say like spread trading isn't something that really, many of us will learn. I mean, I've only learned about it purely from, the prop trading industry. I don't think there's ever been a webinar or seminar where stuff, as people spoke about the spread trades on futures, etc. Was this heard something about exotic spreads? Oh.
Right, Lubos, you've asked a question. Heard something about exotic spreads that contain 3 legs. Well, we'll start from the beginning. A calendar contains 2 legs. What you call exotic contains 3 legs is actually a butterfly. I can actually show you on the chart a butterfly.
So you can probably understand, guys, already there's a lot of terminology being thrown around, which is probably a little bit foreign to most of you guys, as it is to me. Right? So I'm as I typically do, I probably like to learn this and really get my head around it.
Right.
And
who was that for? Lubos.
Lubos.
So you can see it's annoying because the market profile is not enabled on this, so I can't show you properly. But the ladder on the right is a fly that contains 3 legs. So it contains NOV. If we buy this fly, we buy NOV, we'd sell December. We'd sell December by January. So it'd be a 1-2-1, like a butterfly with 2 wings. So that's a 3-legged spread. If you can do double flies, which is a fly against a fly, that would be a 6-legged spread. So you can create permutations with many different legs. If you say exotic for 3, you could create spreads with 10, 12 legs, maybe more. You can create as many legs as you want, to be fair, as long as you think it's going to hold in and reduce your risk. But obviously, the more legs you trade, the more commissions you're paying, and you will pay more margin. But as I said before, with a direct market access clearer, they will correlate most of your legs and reduce your margin. So, Panvia, you ask how many ticks can you typically take on a day? It's a really tough question because if you're trading something like a 1-month calendar, like the ladder on the right, I'm going to show you, you're not going to get filled at neg 51 today. You would have been able to buy neg 50s and you would have been able to sell neg 47s. So you could have only taken probably 2 to 3 ticks in that product. But if you trade something like the deck, that's had a big range today, and I was actually selling it up around here earlier, neg 414s, and it's just got down to a target where I wanted it about 440, just on the close there, on the NYMEX close. So I would say it's quite simple to take 10 to 12 ticks a day on a product like deck, and that only has a 25 tick range at the moment, an average true range.
Would that be just once or twice in the day, or quite a few times in the day?
Sometimes it will do that range twice, so you might see that range traded 20 ticks up, 20 ticks down.
This ain't like scalping in and out. It's going to be like a...
Yeah, it's not worth scalping in and out because, as I said, one calendar, if you buy a calendar, if you buy one and sell one calendar, that's 4 lots.
Yeah.
So for you to buy one calendar and sell one, you've got 4 lots of commission. It works out dearer than doing an outright.
Mm-hmm.
But if you're sitting there and you're trying to hold it, and the beauty is with trading this, I'm going to bring another chart up so I can show you another ladder. So the ladder in the middle is December 16, December 17. So that's a spread in itself. The ladder on the right is December 17, December 18. Now, if I had a good level in December 16, 17, the middle ladder, and I was sure it was a good level, but I was a bit wary, or the market was starting to look a bit, if I was trying to buy it down on the lows and I was worried about the flat price breaking, then I could walk over and sell 17, 18, and that would then give me a fly. So I'd have a 16, 17, 18 fly on, and I've already hedged myself. I've slightly capped the profit I can make on it, but I'm not going to lose as much if it does break down. I'm pretty much probably going to stay flat or a scratch. But if it does start to bounce back up, I can cover my leg on the 17, 18s, and I can run my 16, 17 leg. And the same on the downside, you can do it the other way.
I think it's quite interesting what Saul said. I mean, I always talk about like having a sort of general plan, and sort of like some kind of structure for your trading day. But at the same time, you do got to think a lot on the fly. What you initially was going to do might actually could be a different opportunity shows up now. And I think this is the thing a lot of traders struggle with typically, because they're so systematic, mechanical. It's become like they're like robots. It's like 10 tick stop, 10 tick target all the time.
This is more real trade.
This is like, that's what I mean. It's like, with outrights, we might change the parameters a little bit here and there, but this is very, very dynamic in the sense you've got to spot things intraday a lot of the time. The opportunities are going to show up that you would not have seen before the market opens,
Yeah, I mean, in the mornings, oil, not everybody, but oil mainly starts trading roughly around 2 p.m. London time, when the NYMEX pit still opens, or the times the participants come in is around 2 p.m. in England, which is when the US pits open. So generally in the mornings, oil's quite sedate. Oil's never actually sedate. That's a big lie. But it's a lot slower in the mornings. And some of the calendars might only have a 5 or a 6 tick range. I mean, I might even be able to show you.
I don't see why they're not palm bear, really. If you can chart the spread, you should be able to see, and you've got the depth there. There's no reason why you can't see a footprint on it. You can see what trades are going in, like a time sales, right?
Yeah,
it's just another market, really. So basically, anything you can do with any market, you can do with a spread, really. So I mean, the possibility is quite endless. That's why I'm quite excited to see what I can do with this stuff once I get my head around it.
So going back to that question, can you read the DOM on these spreads? Yes, you can, because they are a spread in their own right, even though they're made up. If I was to buy this ladder on the right, if I was to buy neg 269s now, I would get a December 17 leg and a December 18 leg in the outrights, but I would actually be trading this spread as in its own right. So even though it's made up of the 2 legs, you actually do get a position in the actual spread contract. So the volumes down the side here and the charts and the indicators on the charts are very much like trading an outright. Mm-hmm. So it's a very similar thing.
Yeah, I mean, it'd be good to see some example, some examples at some point. If you was to recommend like a spread for someone new, like most of these guys and me, to start with, if you had a choice, like right now, what would you pick? Just like one spread to focus on, just to get your head around it.
You'd be best off as I said, the shorter the duration, the less volatile. So you're best off looking at a 1 month spread, whether it be a NOV deck, a Jan Feb, a Feb March, a March April.
In Brent crude rather than
Brent tends to be less volatile than WTI. WTI seems to have more sporadic moves out of nowhere.
The WTI on CME, right?
Yeah, CLE.
Yeah.
I think a lot of the players in the States are just bigger.
Yeah.
And when they come in, they really do boss it about. So,
I would say, like, the ICE, like you guys trade the ICE, a lot, and I say the ICE is not a product typically. I see a lot of retail traders trading, and we got the Russell on there. But generally, if you're trading oil, you're trading the CME products. Yeah. But I find it quite interesting that, most of the guys that trade the spreads do focus on ICE.
Yeah, I mean, the spreads don't, on ICE, they seem to be a little bit more mature. Mm-hmm. They hold in a little bit more. It's not to say, I prefer sometimes trading the NYMEX stuff because it does move around, but you just have to be a little bit more careful in the NYMEX stuff.
Yeah. So not for the newbies.
I would say look at them, compare them, and see what you think. Yeah. Chart them.
The price will be the same, though, right?
It will be Yeah, I mean, Brent on NYMEX will be the same price as Brent on here.
Right.
So if I can bring up WTI here actually, so let's bring up QOX. On the left-hand ladder is Brent November, and the middle ladder is WTI on ICE. As you can see, it's not as highly populated as it is on NYMEX, but it will trade pretty much exactly the same price, give or take maybe a tick or two at the high or lows. But there's so many spread machines and algorithms holding it in line, it will not deviate away.
Yeah, I had this question we saw earlier because a lot of us are focused on the CME product. I covered crude oil in the room, but the prices are the same. So I had a question like, these are actually, they're separate products. Like this is actually a different product on a different exchange, and there's contracts going in and out of these markets, so depth will be different, but the price is the same. So the market, and Saul just said, like the market making models are so efficient, they keep the price. That's how efficient they are. They can keep and hold the price the same, even in two different products on different exchanges. Yeah. So in a way, it's controlled.
That's why you look further down the curve for more opportunities where it's not held in so much in the spreads, especially sometimes Brent spreads versus NYMEX spreads. They are different products as much as they're both black stuff that comes out of the ground in barrels. They are totally different products, so you really do have to bear in mind. I'll show you the picture, the difference between.
Could you get a physical delivery on a spread?
Yes.
Yeah, it's the same thing, right?
Same. Yeah. Brent. WTI is cash sell, but Brent is physical. ETQO. This is Brent versus WTI, an exchange listed product. And as you can see, it has some good ranges. But again, I'll go back to some of these moving averages, and they do work well in some of these products.
It's always a question there from Palm. It's always very much a big news trader. That's how he does, and that's your main thing, right?
Event.
Yeah, event-driven stuff, right? I talk about technicals. I don't tend to trade the news itself. I tend to play the setups, but I will trade ahead of news, etc. But Saul is very much a news. He does. I think this is why it's it's interesting to have like Saul with me here in the trading framework. Firstly, he's got double my experience in trading. We trade in different ways, and he's got a lot of stuff to share, which nobody really is doing. I mean, the stuff like even Saul's, I don't know this. This is like, it can be a little bit overwhelming, but this is how a lot of professionals trade. And even what Saul was saying, really a retail broker, you wouldn't want to do this for a retail broker because your commissions are just stupidly high.
Yes, right.
This is why we got the stuff with mindful traders, and we got the lower rates. You guys have seen mindfultraders.net. So Saul is my partner with that. These are the rates here. Like these are per side per contract, right? Yeah. I mean, this is a hell of a lot cheaper than any retail broker, but you can work with these rates on spreads, right?
Yeah.
And also you're clearing through
professional
clearing firm, not like a
2 layers of risk management.
Retail clearing firm. Yeah.
I mean, Parmveer's question is very good. On the back of an event-driven risk, yes, Parmveer, if somebody comes out and says there's a possible cut in production, for argument's sake, and I know flat price is going to go through the roof, a lot of times flat price will have a quick 20-tick blip, and you don't always get them. You end up buying 20 ticks higher, having to wear it for 30 or 40 seconds in your face, and then it goes. But I tend to just walk over to the spread ladder and lift as many spreads as I can shake a stick at, because I know they will go as well. And when the flat price really does go and you have these quick dollar moves, you'll have this. Can I borrow that mouse, Cam?
Yeah, sorry. Yeah.
So
I'm just going to copy and paste this in there quickly. That's just the website there if you haven't seen it before, Mindful Traders.
You'll have, if you have a 100-tick moving flat price, a lot of the time the December contract, which the ladder on the right I'm going to change, this will move 30 or 40 ticks, and the spreads a lot of the time do overham it as well. They over-exaggerate the move, so you can get some real good money out of them. And as I said, you can get some big size off, where you might only get a few lots off in flat price, and you don't really want to do much size in flat price because it's so volatile. In the spreads, you could easily get a few hundred off if you really wanted to, possibly more. So I hope that answers your question, Parmveer.
Okay, guys. I'm going to open up to you guys because we've got like about 10-15 minutes left, really. I'm sure you guys got some questions. Put them out there. Saul, just pick them out. I'm sure many of you also going to have questions after this. So it's been recorded. We did say that earlier. I noticed a couple of guys asked again. So you might want to go over some of the stuff. But me and Saul are going to be doing a lot more of this. So I will get Saul to do some more examples of trades on, so you can actually see them. Now the markets are, going to be slow. We're not going to.
And it's just closed, yeah.
Yeah, it's just closing, right? So basically, we want to take advantage of these kinds of moves. Maybe I'll get Saul into the live room a few times. Maybe run some spread trading stuff there as well. Actually see it live. So we got a question here. Can you give an example of an arb trade? You mentioned Brent crude versus WTI.
Okay, John. Hi. The arb trade I mentioned a minute ago on the chart now, that is, we call it the Brent WTI spread. It's actually quoted as a WTI Brent spread. So this is November 16. So this basically is the difference between Brent and WTI. Hold on 1 second. Let me get the other chart up. ETQO 6, ETQO Z6. So the discount price, basically, as a general rule of thumb, WTI always used to trade at a premium over Brent. So it was approximately $2, between around about $2 dearer. So we used to have a range for many, many years between -$2 and +$2. So WTI would normally trade at a premium, but sometimes would dip under slightly due to demands or supply issues. But over the last 5 or 6 years, this spread has really come into play. So the chart you can see at the minute is the difference between Brent and WTI, or WTI and Brent. So if you look at the middle ladder of 44.26 and you minus 45.98, that gives you this price here of -$1.55. So it's -$1.55 WTI running at a discount compared to Brent. So this is a typical arb trade. This is exchange listed. There's no synthetics in this. This is just, if you do this trade, you get allocated the legs in Brent and WTI. But this trade can be a bit of a beast. It can move a hell of a lot.
I know it's a spread on that. It's quite wide.
I've actually got, where is it?
Because it's just thin.
ETQO.
I was looking at
there you go.
In the middle.
That's the ladder for it. As you see, it's done 10,000 lots today. I find it a very technically driven trade. There is certain times of the month when it does get hit, sometimes after rollover, because there's a difference between rollover and Brent and WTI. The duration dates are different. But this is one of my favourite trades. I tend to like this.
How many ticks would you go for out of that, like right now? Like if you wanted to see, if I was seeing like that going to like 1.600, like it's only a couple of ticks. What's it?
I tend to go for between 10 and 15 ticks.
So there's nothing really in that. It's too tight.
I like it. It's one of my good trades.
Even that tight?
Yeah, I tend to go for 10, 15 ticks in there. When you see a good reversal.
What's the value per contract? Like, CO would be $10 a tick.
Everything's $10 in oil.
Yeah? Okay.
Yeah, so if you do any synthetic, you create $10.
On ice, yeah?
Yep, everything's $10.
Okay.
A lot of, there's products as well like this ARB, the ETQO, where you see sometimes a big order coming. Sometimes someone will put 1,000 lot, let's say neg 172 now. Someone will buy 1,000 or bid 1,000 there at 172. And I don't know why on earth the broker does it like that, but he'll then walk the order up the book for 5 or 6 ticks until he gets done. And you can so many times just jump in front of that order. And when he's done, you just reverse it and go the other way. It's a very good product to trade. I hope that answers your question, John.
Some of you guys probably using Market Delta. I know you can create spreads in Market Delta. I've given it a shot before, and actually you probably see all the symbols listed on IQ Feed's website. Because a lot of these symbols they're not familiar with, even to me, So if you look at the symbol lookup, you probably find them here. You should be able to see, like exchanges, ICE. Which one would it be? ICE. Which one would it be? There's barely so many ICEs on it.
ICE Europe.
FU.
I think it'd be ICE EEC.
Yeah, that one. Yeah, let's try that. So basically, you probably have futures. They've just got futures. I would reckon it's probably going to be listed under the futures.
Actually, into commodity spreads there. Next one down.
Oh, is it?
Yeah.
All right. So that's one, right?
Might be that.
Yeah, I think you probably find them there. Does that look about right?
Spread EEC.
Yeah, that's it. Yeah.
They're the Middle East sour cruise, but I'm sure they'll be.
Yeah, if you keep going, there's going to be hundreds on there.
It'll be literally hundreds.
You can probably type the name in anyway, because you can actually type in the description here and just search the description. So you probably find it that way. So there's actually, there's thousands of symbols on IQ Feed. So I'm sure if you're using another feed, you can find the symbols as well.
They said future spread.
Yeah. Okay.
The answer to your question, Emeka, a lot of people do use the S&P and oil spread. Last year, there was a very good correlation between the two. And because oil was at the forefront of everyone's mind, especially when it got smashed off for from $100 down to sort of 50 odd. When oil did start to move down or started breaking down during the course of a day, the S&P would naturally get sold on the back of it. I don't know if I'd say you could use it to predict the S&P. As I said, I'm a short-term quick trader, and if I saw the oil price moving, I'd just sell the S&Ps anyway, just on the back of it, if that was a correlation at that time.
Yeah, so Palmville, like, are there any more resources? I mean, this is what me and Saul spoke about earlier. There's nothing out there, not on this style of spread trading. You'll probably find something on old school calendar spreads on like agricultural products. There's really no books on this stuff, and like, you know, there isn't, you know. So this is why we're doing this, you know, because it's not, you know, this is something that, you know, nobody's sharing really unless you're in the prop trading world, you know. So
and nobody shares it with you.
Yeah, anyway. When I started teaching market profile, auction market theory, order flow, there was nobody around. There's 3 people around the world, you know, and like this is, you know, this is something that people just don't know about. They don't, even I don't know, you know, because you can't find the information on it. You search even the internet, you'll find fuck all on there, you know. So this is why I'm doing this with Saul.
Yeah, Palmville, you're right. They keep it to themselves. And John, is there any spreads on heating oil? Yes, on NYMEX, there's heating oil. Code is HOE. It's quite liquid. There's not a lot of size on the ladders, and it does move about 600 ticks a day, or $6 a day. It trades off the back of, we're saying that it doesn't always trade off the back of the flat price. Yesterday, for argument's sake, heating oil and gasoline was up $2 when the flat price was down $2. There was a major disconnect yesterday. But yes, heating oil is good. You can trade the calendars in heating oil, which is good. Natural gas as well. And gas oil on ice. There's also a spread between ice gas oil and NYMEX.
It's pretty much unlimited. There's so much more you can trade. I mean, like, you know, spread. You can spread pretty much anything. You know, any market. You know, if you can spread currencies.
Yeah.
Right. Anything. Treasury, bond markets, indexes, anything. The thing is, again, I think you have to specialize. You can't trade every spread out there. Like, you know, Saul specializes in a few that he likes and understands. You know. And I think, you know, there's so many things you can trade. Sometimes people ask me, why don't you trade the euros? Because there's many markets out there I don't trade. You just can't trade everything.
I don't like currency you know? Personally.
Yeah, I'm not really a currency guy either. You know,
so yeah, in answer to your question, John, it is very liquid, but you will need a very wide stop on it. I'd say if you can't afford 100 tick stop on heating oil, then don't trade it.
Yeah, I mean, the interest rate derivatives like the Bund bubble shats, the flies, that used to be, that was a very popular spread. I mean, that when I was back when, you know, you guys were Saxons, that was like a very popular spread, right?
Yeah, they were the big spreads. I mean, I've always, in answer to Nick's question, yeah, I have always spread the treasury markets as well. I don't tend to do the 2, 5s, 10s anymore, especially as we're now going through a possible interest rate cycle of hiking and everyone's unsure. But I do like what we call the TED spreads at the moment, which is the euro-dollar curve. So the euro-dollar futures against the 2-year. So then TED spreads are good. Again, they blow out occasionally.
Nick's just added their 10s, 30s.
10s, 30s.
Yeah, anything really.
You can spread them, Nick, but personally I don't. I don't like the 10s, 30s.
Anyway, into like outright.
Yeah, I prefer the, if I was going to do them, it's the, to be honest, I don't like the treasuries anymore. 5s, 10s, 2s, 5s, 2s, 10s or whatever. I prefer the TED spreads being the euro-dollar curve against one of mainly the 2-year. So I wouldn't really trade them. If you trade them, good luck, but I'm a bit wary of them now. And Palmville, Mandara won't tell you a single thing.
Yeah. All right, so John, again, you know, you just had this question earlier. Where can I get more information? Like I said, there is no more information out there, educational materials. And a lot of the time, this kind of stuff, you can't really learn it on. It's in theory. This is practical. You've got to see it done. You know, that's why, you know, me and Saul, you know, we got this stuff up. You know, I bring him into the room whenever we can. You know, we'll work something out. You know, I'm doing some more scalping stuff right now as well. Me and Saul are going to actually put our heads together and actually create a course at some point, like a weekend thing, or, you know, a couple of days maybe during the week, to teach more on this, because at the moment this is just more of an intro. But clearly there's a level of interest in this, and I'm definitely interested to learn more. You know, me and Saul, because, you know, obviously in terms of charts and things, I've got a great way of understanding the markets from that perspective. But I think there's a hell of a lot of potential here to take advantage of this as well as the outright positions, you know. So it was really more of an intro, you know, and that's it. And I mean, I still don't get it, right? You're not going to get it all in 1 hour today. You know, it's impossible. So that's why, you know, we will be putting more up there. Saul's going to be doing a hell of a lot more. You know, Saul's the guy that got me into prop trading. He's got, you know, double my experience, you know, and, you know, we're working together with Mindful Traders. We set that up. It's a clear, you know, IB, but we're clearing through prop firms, the same firms that we clear through. We've got the risk limits that you have to have. Retail brokers are not going to give you that because it's not in their best interest to stop you trading. They want you to trade as much as possible, no matter what you lose. So that's why you don't get risk limits. You're not going to get the lower rates. So that's why we've got the clearing set up. I mean, we're giving the stuff that you guys don't normally get. You know, in a way, I've sort of built a bridge for the public retail world to get from, you know, my connections like Saul. You know, he's built prop firms from scratch. Being a, you know,
we built a prop firm. We had 150 traders. You know, we've got offices everywhere. So hold on, I was going to answer that question from Jacek.
I can bring it back.
Any tips on risk management? Where are we? Any tips on how we can manage risk management in directional markets? Well, Cam will tell you, I've been a risk manager as well for many years. I've trained and risk managed. You know, I couldn't even count how many traders, well into the high hundreds. I've seen every single trader there is. I've seen small traders who just job around and scalp. I've seen big traders who trade up to 2,000 or 3,000 clips at a time.
The first day I met Saul on the trading floor, I remember he had a Recaro chair trading seat and he was trading 10,000, 20,000 euros a tick on the Bunds. I was like, what the fuck? and then the computer crashed.
Oh yeah, I do remember that.
And all that IT. But yeah, I mean, the thing is, Saul's wealth of knowledge and experience, and that's why I'm sort of given, in a sense, I think, you know, he's got a hell of a lot of knowledge and experience to share. You know, and I think, you know, you guys would benefit from that. I will as well. So this is why we're doing this together, you know, with the trading framework. But, you know, this is, as I said, it's not out there. This is why you guys are asking for books, education material. There's nothing out there on this. It's not. You need to see this done.
Jacek, the answer to your question, it's a hard question to answer. In a directional or a trending market, risk management isn't always about stopping yourself out or a limit loss or a financial amount you're willing to lose, or if the trade's wrong. A lot of the time, it's not as silly as it sounds. You've got to look at it backwards to look forwards. It's a lot of it, in my opinion, and what I teach my traders is how you get into your trade. If you can pick the right entry price and you don't have to wear a lot of pain, especially in a directional market, then your risk management, you hopefully never have to really use your risk management to its full extent. And hopefully you don't get a tap on the shoulder for someone like me as a risk manager telling you to go home for the day. So in a directional market, you know, you just got to, the old saying, and I hate this saying, the trend is your friend. Just don't go against it. I sit there and watch traders sell 100-tick rallies and they don't initiate one single long, and it really infuriates me because, you know, if something's just going up, don't keep trying to pick tops. Either don't do anything or wait for a pullback, or just wait until, you know, if you're not sure what it's doing, don't do the easy trade. The easy trade is to fade a market and just go against it. And that's just so wrong because you won't be in the game long. So just keep your eye on your risk in a trending market or a directional market. Just be sensible.
I mean, the thing is, like I've said before, like I always say, you need a risk limit. You need a risk limit. I've been saying that for years. I didn't know that existed until I went to prop trading. Prop traders, a lot of them are still in the business. They're staying there a lot longer than retail traders purely because they get cut off, right? They get cut off when they're done. They haven't got a choice. They have to go home and come back the next day. What happens with the retail trader with no risk limit? They get angry. Revenge trade. That's why you can make 30,000 in a month and then blow it in 1 hour. All right, that's why it happens. It shouldn't happen. No such thing as blowing up an account. That shouldn't exist. It shouldn't exist. It doesn't exist in the professional trading world. It only exists in the retail trading world because the brokers won't give you what you need. And that's why we set this up, right, with the Mindful Traders thing. Right now, the other thing is, by the way, our email address is there, mindfultraders.net. Yeah, I missed the D, but it's mindfultraders.net. So we got that, the tradingframework.com, of course. You can send me or Saul an email. I think if you've got any question about the spread trading stuff, obviously direct that to Saul because I won't know what the answer is. Yeah, we'll be doing a lot more stuff, and Saul's on board with me with the trading framework stuff as well. And So
I will answer them. Last two questions.
Yeah, Saul, you take those. Yeah.
Sean, in answer to your question, it varies a lot. I mean, I would say as a ballpark figure, maybe 5%. So if you had, 100 grand in your account, risking 5%, 5 grand, well, it's not a massive amount of money, but it'll keep you in the game.
Yeah.
It's not always about how much you're willing to risk. It's position sizing your trade to cope with that amount of risk. It's not how much you can bear, because if you give yourself a complete amount you're willing to lose, or what percentage of capital you're willing to lose, you're always giving yourself a target of what you're going to stop yourself out at.
Mm-hmm.
And so many times you just put a trade on because you think, well, I'm allowed to lose 5%. Rather than picking a good trade, you should pick the good trade. You should always have a plan in mind and a figure in mind. But I think sometimes the planning of the trade and what you do with it, you should never get to your 5% anyway.
Your risk limit, I mean, I've got a risk limit like 5,500 euros on the book. I never hit it, but I see consistently people will push it right to their last, right to the last dollar or euro.
Yeah.
The thing is, your job, that risk limit is there just in case you can't control yourself. You should not be, it's not an objective to hit it.
Yeah, that's what I'm trying to say.
It's not an objective to hit the risk limit.
People turn it into a target or an objective.
And it's like, if somebody's up 3 grand, but their target's 5 grand, then stop at 3 grand because they don't want to risk what they're up. This is why I would say people are willing to take more risk when they don't want to lose.
Yeah.
Okay. In order to not lose, be proven not wrong,
you'll lose more.
You would lose more. Like you would risk 10 grand instead of 5, just in case you've got this chance to be right.
To be fair, it's out of your control once you get above your stop, because you're then in the land of, well, I've lost more than I should have done. I might as well do a few more quid. And then, you know what? You might as well stop trading because you're never going to build an account.
Yeah, that's why, like the guys that I'm, one-to-one coaching with us, that I get them clearing for us, because we got a dual risk layer, not just the prop firm risk layer, but me and Saul. When we're coaching students, we can actually see what they're doing. I can see their trades every day, right? So what positions they're
in real time.
In real time. So we're not going to, if we see something's up, we'll give you a call. So that's how a proper risk test should work.
And we're not just going to give you a call and say, right, off you go for the day. We're going to give you a call and ask what happened. We're going to try and get to the bottom of why you were doing that and try and resolve your issue or your problem.
Yeah. I mean, the thing is, and most of you guys know, I do the stuff with the NLP time, but it's all practical stuff. I mean, I've been doing the NLP stuff for over 10 years. But Saul has got a load of experience in terms of the stuff that he does. There's, with the news trading stuff, the spread trading stuff. He's trading and he's been in it, 20 years now?
Yeah.
Yeah. Right.
And we get the news a lot quicker than the retail guys, trust me. We're in and out by the time you've got the news.
Yeah, that's it. That's
we get the news
the live
much
school
quicker.
There is different. I have a live school from Trade News, but it's nothing like what you get on the trading floor. So I think Saul's a great resource, and this is why sort of I wanted to do this, and because I think he's got a hell of experience and knowledge to share. And initially I don't think in a few years you'd sort of do it anyway with your traders.
Yeah.
But it's not to this world. It's to the the prop trading world. So that's why I wanted to build this bridge and get Saul here. We're going to do a hell of a lot more. So this is just an intro to spread trading. Right?
I'll answer that one last question. Cameron, how's ticket value affected with different products? For example, in the oil curve, most of the products are the same value. They're $10 a tick, apart from heating oil, which is $4.20 a tick, and gas oil, which is $25 per quarter tick. So you just have to change the ratios you trade. So gas oil and heating oil, as an example, they're two products with totally different tick values from anything else. So a $25 a tick against a $4.20 product.
We usually have the spread ratio matrices.
You do, yeah. It does change slightly, but it tends to be heating oil, gas oil is a 4-to-3 ratio. So you could do 4 gas oil, which is $25 a tick, or $100 when you're doing 4 lots, against $12, $4.20, $12.60 on your heating oil. So a 4-to-3 ratio, because the heating oil is so much more volatile than the gas oil. So you have to take into account the tick value and the volatility of how much more they move a day. So there is ways of working it out, and we'll address them in another course.
So would you be up for doing a few examples, like live stuff, like I'll invite you down here, do some stuff with me when you're
I'm more than happy. I mean, if
I'll get like you guys in the room, I'll get Saul down here a couple of times. We'll see some stuff like when the market's a bit more active. So there'll be a lot more coming. So any questions, send them our way. But there's a lot of bullshit out there right now where people are saying high frequency trading systems have ruined the day trading game. You can't scalp anymore. You can't do it the same way you could have done a few years ago. But so there's someone. What are you making? How much? Millions?
There's people making millions and millions.
Yeah, that guy today we had a discussion. 30 million.
Yeah.
In a month. So it's fucking bullshit. You know, the thing is, a lot of guys are blind leading the blind. That you go to a trading forum, everyone is on the trading forum because they don't know the answers. They're going to give you an answer to your question, even though they don't have the answers.
And to be fair, most of the people on these trading forums, you know, there's a lot of good guys, but you don't get a lot of information shared. Obviously, you know, no one can.
When's the last time we went on a trading forum?
I've been on for ages.
I only went on there once because someone's bad mouthing me, apparently. But I don't go on those things.
No, you know, no reason to be bad mouthed. So
exactly, we did the right thing.
Yeah.
So, all right, guys, we're going to cut it off there. But I'd like to say thank you, Saul, for coming down and doing this.
And feel free to email me any questions you have. I'm more than happy to help.
Yeah, it's been recorded. I'll send it out to you guys. So, you know, I hope you guys appreciate the time Saul's put into this as well. And I'll speak to you guys soon. Take care.
Bye, guys.